Financial Management, Chapter 1, Principles of Finance. The field of finance is closely related to economics and accounting. The financial managers need to understand the relationship between these fields. Economics provides a structure for decision making in such areas as risk management, pricing theory, and return analysis, and many other important areas. Accounting is sometimes said to be the language of finance because it provides financial data through income statement, balance sheet, and statement of cash flows. So financial manager need to know how to interpret and use those statements in allocating companies' financial resources to generate the best return possible in the long run. So in this chapter, we will learn the importance of finance in personal and professional life, and we're going to identify the three primary business decisions and then key difference among the three major legal forms of businesses. And you're going to understand the role of financial manager and the 5 principles of finance that form the basis of financial management. The first section, Finance Overview. So finance is a study of how people and businesses evaluate investment and raise capital to fund them. There are 3 main areas in finances. The first area, so what type of long-term investment should a company undertake? And then the second area, how to raise money to fund those investments. And third area, how to manage those cash flows. Capital budgeting decision, capital structure decision, and working capital management. And there are 3 types of business organization. So sole proprietorship and partnership and corporation. Sole proprietorships is a business owned by a single individual. So they are responsible for all of his company's debts. They typically raise money by investing their own fund and by borrowing from a bank. So this sole proprietorship represents single person ownership and offers advantage of simplicity of decision making and low cost. Advantages are easy to make and no need to consult with others. It's very simple to make a decision, and profits are taxed and owner's tax rate, not corporate rate. But disadvantage is that, so major drawback is that there is a unlimited liability to the owner. So in settlement of company's debts, the owner could lose not only the capital, but also personal asset. The business ceases on the death of the proprietor, limited access to external source of financing. Partnership is a general partnership is an association of 2 or more persons who come together as a co-owner for the purpose of operating a business for profit. So it's very similar to the sole proprietorship, except there are 2 or more owners. So multiple ownership make it possible to raise more capital and to share ownership responsibilities. Advantages: relatively easy to start. The company profits are taxed at personal tax rate and access to fund from multiple partners. But disadvantages are partners still have unlimited liabilities. It's not always easy to transfer ownership. And there are 2 classes of partners, general partnership and limited partnership. So general partner runs the business and faces unlimited liability. However, the limited partner is liable only up to the amount the limited partner invested. So life of a partnership is tied to the life of general partner. Corporation. If very large amount of money is needed to build the businesses, then typical organizational form is corporation. Corporation legally functions separately and apart from its owners. Corporation can individually sue and be sued, and can purchase, sell, or own property. It means that corporation is unique. It is a legal entity unto itself, and legally owned by its current set of stockholders or owners. Board of directors are elected by the shareholder, and the board members appoint the senior management of the company. Advantages are the liability of owners is limited to invested fund. So their liability exposures is generally no greater than the initial investment. And the life of corporation is not tied to the state of the investors. So for example, Thomas Edison founded General Electric over 100 years ago. He died, but his company still lives on. And easier to raise capital, but disadvantages, greater regulation and double taxation of a dividend. It means that if the corporation makes some profit and net income, then net income must be taxed. And then if they pay the dividend to the shareholder as owner, they have to pay tax on the dividend received. Limited liability company has become a popular vehicle for conducting businesses because it is highly flexible structure. So it combines the tax benefit of partnership, so there is no double taxation, and with a limited liability benefit also.